Welcome to the Explainer. Today, we're digging into the electronic component distribution industry. Now, I know it's a sector that doesn't usually get the spotlight, but trust me, it is absolutely critical to the entire global economy.
Think of it like this. This industry is the hidden nervous system. It's the essential link that connects the brilliant companies designing semiconductors with the massive factories building every single piece of tech we use every day, from our phones to our cars to the servers running the internet.
But this whole sector just went through a really painful destocking phase, where warehouses were just overflowing with unsold chips. So as we look at the 2025 data, the big question is, what's next? Are we looking at a huge rebound or something much worse? The signs are, well, they're incredibly mixed. What we're seeing play out is this fascinating strategic battle. On one side, you've got these Western behemoths, Arrow and Avnet, that operate on a just massive global scale. And on the other side, you have these agile, super-focused leaders in the Asia-Pacific region, and they win with deep local technical expertise. Today, we're going to dissect both of their playbooks.
Okay, so let's dive right into the hard data for 2025, because the numbers, they reveal the very heart of this conflict.
First off, just look at the staggering difference in scale. It's not even close. Arrow and Avnet are operating in a completely different universe. We're talking tens of billions in revenue. The APAC leaders, while they're very successful, are playing a whole different ballgame.
But revenue is only half the story. When we look at gross margins, basically what they make on each sale, the Western giants are commanding margins that are more than double their APAC counterparts. Now, this isn't just about being bigger, it points to a really fundamental difference in the kind of value they're providing.
To really get how these companies tick, we need to look at a key metric called inventory turnover, or DIO. The best way to think about it is like the pulse of a distributor. It tells you exactly how fast it can move products off its shelves and turn them into cash.
And this right here, this illustrates the whole strategic trade-off perfectly. A regional specialist like Infotronic has a lightning-fast pulse. It turns its entire inventory in just 21 days. Meanwhile, a global giant like Avnet takes 96 days. Sure, that reflects its incredible scale, but it also means it's holding way more inventory, and with that comes a lot more risk.
Now, here's where things get really interesting, and frankly, a little weird. This industry has what's called counter-cyclical cash flow. As this HDIN Research analysis puts it, these companies actually generate cash during a downturn and, get this, burn through it during an upturn. It seems totally backwards, right?
And this is such a crucial point. Let's take a company like Best of Best. It posted a $10 million profit. Looks great on paper. But it actually had a negative cash flow of $55 million because it was aggressively buying new inventory to get ready for the market rebound. That is the paper wealth trap. It means profit doesn't equal cash, which, for investors, is a huge warning sign. A company can look perfectly healthy on its income statement while actually facing a serious cash crisis. At the same time, a giant like Avnet generated a massive $725 million in cash during the downturn just by selling off the inventory it already had on its shelves.
All right, let's switch gears and look at the competitive landscape. We're going to see how these different financial models translate into two completely distinct playbooks for winning the market.
So the Western model, which has been perfected by companies like Arrow, is about so much more than just shipping components around. A full 30% of its business comes from its Enterprise Computing Solutions division. We're talking high-margin cloud services, software, complete IT solutions. They're not just moving parts, they're selling an entire ecosystem.
The Eastern model, on the other hand, well, it relies on a whole different kind of value. It's all about deep, hands-on technical integration, provided by people called application engineers and field application engineers, or AE/FAEs for short.
This strategy, as the research report notes, is all about becoming an absolutely indispensable engineering partner to your clients. These AE/FAEs help customers design chips directly into their final products, which creates what the report calls extreme business stickiness. Once they're in, they are in. And this is especially powerful as China pushes to design more of its own domestic chips into its technology.
So here are the two playbooks, side by side. The West offers a one-stop shop with global scale and those high-margin solutions like software and cloud. The East provides deep, local, technical integration. They become an engineering partner and ride that massive wave of domestic chip adoption in Asia. Two totally different philosophies.
So, with these two competing models, where is the whole industry heading? Well, the data from every single company points to two powerful, undeniable forces that are reshaping the entire landscape.
And it doesn't matter if you're reading a financial report from a company in Phoenix or one in Shenzhen.
Across the board, two growth drivers are mentioned above all others: artificial intelligence and automotive electronics.
The AI boom is causing an absolute explosion in demand for the most advanced logic chips and high-bandwidth memory, the real engines of this new era. And at the exact same time, the transition to electric and smarter vehicles is creating a completely new high-value growth curve for specialized power devices, microcontrollers, and smart cockpit components. These aren't just trends, they are foundational shifts that are totally redefining what's valuable.
So what's the final verdict as we look ahead to 2026? Well, the industry is definitely starting a recovery, but there are some pretty significant risks hiding just beneath the surface.
For anyone investing in this space, the analyst report flags three major risks to watch out for. First, some tricky accounting. A company might use something called inventory provision reversals to make their profits look better than they really are. Basically, they're taking back money they'd previously set aside for unsold stock. Second, dangerously high debt. A company like Infotronic is almost entirely funded by debt, which is incredibly risky if there's another downturn. And third, geopolitical risk. A key supplier getting put on a government trade blacklist or entity list, which can just wreck a supply chain overnight.
So here's the crucial point. The game has changed. Success is no longer about just moving boxes of components from point A to point B. The future winners will be the distributors who can provide real, value-added engineering solutions in the hottest sectors. And right now, that's AI and automotive. And this leaves us with one final provocative thought. As this whole industry pivots from scale to service, who's going to win? Will the future belong to the global giants of the West with their vast resources and software ecosystems? Or will it be the domain of the deep, technically focused specialists of the East who are making themselves indispensable partners in this new age of technology?
It's a question that's really going to define the next 5 years for this entire industry. Now, if you want to dive deeper into all the data and the complete analysis that frames this question, the source for this explainer was the full report from HDIN Research. You can find it on their website. Thanks for watching.